My name's Ethan Braid. Today we're going to talk about the 4% spending rule and 3 different strategies to employ the rule. Not everyone interprets the rule in the same way, so I'm going to show you 3 different methods to put the rule to work for your portfolio, and then you decide which one is best for you. The first method that we'll discuss will be what I call inflation adjusted, or the rigid form of the 4% spending rule. Rigid because we're starting in the first year of our retirement with a 4% distribution, and then we're growing that distribution every single year by inflation. In this case, I've used 3% inflation. We're making an investment in the Vanguard Balanced Index Fund for $1 million on January 1, 2000. And what we see is that over the last 23 years, while the 4% spending rule inflation adjusted method has worked for us, our security in retirement is declining. We're now down to about $700,000 over 23 plus years. Here are the numbers for the inflation adjusted distribution strategy. Starting January 1, 2000 with our $1 million investment, $40,000, 4% comes out the first year, and then we grow that by a rigid 3% inflation every single year until we finish this year at $699,000. The second method for using the 4% rule is what I call the floating distribution strategy. With the floating distribution strategy, you'll be taking 4% every year off your portfolio based on an at-the-time value of the portfolio. Over time, your distribution is going to go up and down as the market value moves up and down due to underlying investment performance. Our illustration here for the floating distribution is based upon the same investment amount in the Vanguard Balanced Index Fund, $1 million, January 1 of 2000. And what I like about the floating distribution is it gives you a chance at creating more security in retirement. What we see here is that our investment of $1 million is now almost $1.5 million 23 plus years later. The problem with the floating method is that your income is going to be variable. So if your portfolio value goes down, like what we saw in 2002 and 2008, and your income drops below your budget, now the 4% distribution rule floating rate method has failed your retirement plan. So it's important that the income or the distribution coming off the portfolio stays above your household spending needs. Here are the numbers for the 4% rule floating method distribution. Starting January 1, 2000 with our $1 million, January 31st, we take out our first 4% distribution. And then every January 31st, we're taking out 4% of the at the time portfolio value. What we can see is that our portfolio income starts going down due to market losses in the early 2000s. Then the market recovers and our portfolio income starts to move back up. Then we have 2008 and we take a drop on portfolio income, then we get the recovery. Over time, our income is moving up, but again, it's up and it's down. The trend is up over time, but in the short term, you can have periods where your income is going to be up and down. If your budget can handle the variable income of the floating method distribution strategy for the 4% rule, then this is something you really want to consider. What I really like about it is that it gives you an opportunity to grow the value of your retirement nest egg throughout your retirement. The third method for using the 4% rule is what I call the fixed distribution strategy. This is very simple. Whatever the portfolio value is that we start with, we take 4%, and then that amount never goes up and it never goes down. It just stays fixed. Like the floating method, the fixed method also gives us a very good chance at growing our wealth throughout our retirement. In this illustration, the fixed distribution method gets us to almost the same place as the floating distribution method. Here we are starting January 1, 2000 with our $1 million investment in the Vanguard Balanced Index Fund, and then 23 plus years later, we're finishing at almost $1.5 million. Here are the numbers for the fixed distribution method of the 4% rule. Starting January 1, 2000, our $1 million, and then simply taking out $40,000, 4% every year and not moving that distribution up or down the entire time. Notice that we finish at almost the same ending value as the floating distribution method. Now let's take a look at a comparison table with the ending results for all three different distribution methods of the 4% rule for the 23+ year period. The inflation adjusted spending strategy gave us a lot more money to spend throughout the 23+ years, but we also ended up with a lot less money at the end of the time period. The fixed and the floating distribution methods had comparable spending levels, but a lot more money in terms of ending value. Over here on the far right column, I've got the spending plus ending, which I would consider the total return to the family. And you can see that the fixed and the floating give a lot more total return overall to the family than the inflation adjusted strategy. I hope this video was helpful. I hope this video gets you thinking about your retirement and helps you improve your family's financial plan.